Good morning, everybody. Glad to be here. It's very, very nice to see so many people turn up. It's our first, I would say, big event where we are sitting in front of each other without a mask. So good to see everybody's faces here. I'll just talk a bit about how what. Start with the report card. So maybe that's the first thing. If you can, somebody can put the slides on. Yeah, thank you. So what I'll do is talk about our financial update, operation progress we've made on the operation side, as well as I'll invite Vivek to talk about the M&A journey. We've shared that with you last year as well as an annual process. Given the investment we'd had, we want to make sure we give you latest update on the performance on the M&A side. Starting off with report card, right, which is favorite from a finance perspective. What did we tell you last year when we'd met and through the year? These are the few things that we'd articulated. We'd said we had made certain investment in the business, in our large deal capability, be it on some of the competencies we got inorganically, some of the organic competencies, and the investment we did on the solutioning side, right? Based on that, we said, we're going to up our run rate on the large deals. We're going to be a $700 million to $1 billion range. We were earlier at a 300, 400 million range on a quarterly basis. So this is something we thought is sustainable, looking at the pipeline and the processes that we had. As you have seen the year gone by, we've achieved this metric and been in the range throughout the year. So that's been the positive. On the revenue side, we'd said, we'll be double-digit plus. We'd given indication around how the growth will look like for us. When you look at the journey, it's been in that direction. Last couple of months or quarter has been more influenced by the macro environment. You see some sluggish, growth there. But overall, when you look at the year, look at YTD, we're in the ballpark that we'd mentioned. So positive in terms of what we said. EBIT is one area where, and I'll talk more about it, where we are and what were the reasons. Some of these are conscious investments we did for the long term. Some are market trends that impacted much more than we anticipated. And hence, I'll give you a walk on that. So that's one area where we need to improve. In terms of our M&A journey, we had communicated to you, if you recall, end of FY22, we had invested close to $1 billion in multiple acquisitions to build our competencies. And we'd said that our focus for this year is going to be integrating all those competencies, right? So we've kept our focus there. And in terms of allocating capital to anything new, we said we'll stay away from it, as CP explained, and focus, given the huge investment, on integrating all of this, right? So that's something we've continued to be on trend. And then capital return, CP spoke about it on the interim dividend, but generally we'd articulated to all of you that our policy is whatever we generate in cash minus the M&A will return back in terms of dividend to our shareholders, right? Given not much investment in terms of M&A over the last 12 months, we continue to look at that math and make sure that we follow the policy as we move forward. So again, an area that we are on track on what we communicated to you. What I'll do is talk a little bit more on all of this and how we got there, where are we headed in the next few pages, so that I can elaborate more. When you look at last year what we said, we were also looking at how the trend has been for us. So if you look at some of these metrics, I'll go one by one. I already spoke about large deal TCV. We were averaging around $450 million over the last 4 to 5 years when we analyzed the data. There were some ups, there were some down. But as a systemic process, like we've executed in the last 8 quarters, we have been in the range we articulated. So we've almost upped that run rate 1.8 times, right, what we were. So below that, there's a lot of investment that's happened, and competency investment that we did, solutioning investment, our investment in refreshing the sales commercial team across different geographies. All of that is the underlying reason why we got here. So that's one big piece. Second, when we look at our quarterly, kind of growth rates, CQGR, and compare that with FY 16 and 20, which is the blue graph, with what's been a trend in the last 8 quarters, you see that it's grown from 1.4% to 3.2%. Some of it is also reflective in the market, but it also required for us to inherently rehaul a lot of areas within the organization. That's what's reflecting in this growth number. EBIT is one area I spoke to you about. We've improved, but there's still more lot to do, and I'll take you through the walk. When you look at the payout, from an FCF to PAT perspective, what we're generating from the business, we continue to drive that better. From a payout perspective, when we compare 5 years number to last 2 years financial year, we've increased our payout ratio from 49% to almost 88%, right? That's a significant uptake. And then from an ROC perspective, you see an expansion of 60 basis point in the 2 data periods, right? So from a metrics perspective, we're looking at this constantly. Our endeavor is to keep on getting better, and we will make sure that as we move forward, we show the progress on all of this. So this is margin walk, right? I just wanted to explain this a little bit because this has been a constant discussion and one metric where we wanted to explain more what's happened, right? So when you look at our drop in margin from last year to this year, I kind of break it down into 3 buckets, right? The first bucket is where we articulated that we invested significantly in our competencies through M&A, through inorganic route. Now that helps us a lot, and you can see that, right? Our large deal wins are better. Our discussions with the customer are more sticky. We're able to offer more differentiated value in terms of business transformation. So all of that is helping us long term to build credibility. Our competencies around cloud, digital engineering, high tech, BPS, XDS is much more significant as it used to be. Now that investment in short term, and I explained it to some of you in our discussions, comes with some accounting charges, right? We have a customer relationship that gets amortized to the P&L. We have certain earn-out costs that gets charged to the P&L, because of which we had an impact when we look at last year to this year financial, right? So that's one part of the bucket. Second part of the investment that we did was we wanted to change the business from a long-term perspective. We wanted more sustainable, long-term, sticky revenue. And we said one of the things that we got to up is large deals, right? That's why you see so much investment that we did in our solutioning capability. M&A is also helping us there. And then the whole commercial rehaul that I spoke to you about. So with that, as you would know, a large deal typically comes with a cycle time where the first 18, 20 months requires a lot of investment, transition, transformation, and then the uptake on the margins happens. So it's a nature of cycle, if you will, that will start turning as we get matured on those deals and gives value, right? So that's an area, again, we decide as an investment we got to do. The third bucket is something where we call it a value gap, where last year it was unprecedented times, right? The supply side market was very, very hot. You saw wages rising like anything. So you would have a replacement which will come at a 30 to 50% more expensive rate than a person leaving. So when you look at wage increases or inflation, typically you would see the trend to be 1.2, 1.3%. That almost doubled or more than doubled, right? Last year for most of the peer set, including us. We made a lot of effort to offset it. We spoke to you about our initiatives on pricing. We ran that like a war room. We got significant price uptakes. We drove a lot of productivity measures, and I'll talk about some of those productivity metrics to you. But between both of them, we couldn't still offset the impact on wage and inflation, right? It was not enough. So that was the third bucket where we had a value gap erosion. So between the 3 of these areas, 2 of them which is long-term investments and 1 which was driven by the way market was, our margins got reflected in what you see from a reporting standpoint, right? Now, the way to look at this is, the first 2 buckets will come back as we move forward, and as we talk about our journey in the future, there will be the drivers to expand margin, and we'll continue to look at productivity as we move forward, and I'll talk about the long-term walk for you. But this is a way, at least we internally discuss, and we make sure that we keep on looking at these levers. Now again, when you look at operating metrics, which was the last bucket I showed to you in the previous page, these are some of the areas that, from a last year to this year perspective, we've performed on. So utilization, if you recall, we'd said We've done some investment in hiring freshers last year. Our utilization will ramp up as we move through the year. And from 83%, we executed, or we are at 83 to 86% now, right? So that's an area we continue to improve on. From an offshoring perspective, we continue to make a lot of significant inroads in getting more and more offshoring. But as you do more and more large deals, it comes with typically high on-site population. And as you execute them, as you get the large deals in a maturity state, which is what I explained to you in the margin walk, this will also keep on improving more, right? Versus what you really see here. In terms of attrition, this has been a tremendous effort. Last year, if you recall, we were getting into a phase of inflation across the industry, ranging from 25 to 30, 32% for peers. This is one area where we made a lot of internal investments, efforts, initiatives, and now the attrition for us is, in terms of leader of the peer group, we are at 17%, and this will continue to go down. The market is also easing now, so I think this is one area where we are really, really happy with the way we've made internal efforts. In terms of subcontractors, this is again a metric which we had articulated to all of you guys. Because of COVID, various other reasons, we had exceeded where we wanted to be from a comfort zone perspective. We feel we can get a substantial reduction in this as we move forward. So this will continue to be a lever for us to drive margin expansion in the next 4 or 5 quarters to come. In terms of way forward from here, so this was, what happened in the past, how we did last year. Now the question is, what's the strategy for us as we move forward to execute our critical go forward metrics? So if you look at, very simple, 4 pillars of our strategy. Drive organic growth, that's what we're going to focus on. We're going to drive margin expansion, and I'll show you how. We spoke about the value that the portfolio is creating in terms of synergy, and I'll just invite Vivek to talk 3 or 4 pages to share our journey in the last 12 months and even 2019 onwards, how our M&A strategy is working for us, right? And what's in store in the future. So just, I'll take it one by one. From an organic growth standpoint, and we'll do a little bit detailed sessions in some of that. CP already mentioned to you. CTL will talk about customer co-creation projects, which is the new growth areas. We will talk about, large deal wins through our panel discussions that we have, as well as account expansion. But broadly, these are the themes that we have. We'll continue to execute our large deal wins. We'll continue to penetrate deeper in our accounts that we have. CP spoke to you about the 1,200 plus accounts we have. We have a differentiated strategy for each of them. We have more competencies to offer. So if a particular account is being catered predominantly by IT services, we have a very strong practice on XTS. We have a very strong practice on network. We have a very strong practice on BPS. So we have multiple competencies to now offer the same customer. Those customers anyway trust us with what we've delivered with them, and hence there's easier pitch for them to get more and more business and more wallet share. So that will continue to be an important strategy as we move forward. We'll also talk about the new growth areas, product and platform Manish will talk about, and then CTL on customer co-creation. In alignment with our growth strategy, one thing we've done internally, we've increased, we did a lot of investment through M&A in 2022. As we look into 2023, we've increased our share of internal investments. And as we look forward, we'll continue to drive that more in terms of investing in the competencies and changing nature of the business. So if you look at the pie chart, it just shows you wherever we're spending money on, and these are more internal investments. We were building competencies, we were doing little bit of investments in product, and then co-investment with customers were a smaller share. As we move forward, FY23, FY24, we continue to do more and more work, which is very, very interesting with our customers. And these are very, very innovative areas, very advanced areas where we're investing, in co-creation. So we'll talk more about that. And similarly, the whole potential we have in product and platform business is tremendous. We have already established practice. As we invest more in that, we'll show you the path, what is in store from a growth perspective. So these are Two messages here. One, internal investments increasing overall, so that long-term nature of the business gets more sustainable. And then second, a mix in investment into newer areas so that we are more aligned with the new digital strategy. This is the margin walk I'd shown in the last discussion also. What drives and what potential we have. So we already spoken about FY22-23, so I won't talk about that. But as we look forward into the next year and the year forward, you see, we have a lot of levers to work on. CP spoke to you about one element, which is while we'll continue to invest in the business, we will also make sure that we're divesting areas which are non-strategic, which are not giving us the value and don't cut the return metrics for us, right? So we will divest to further invest in the business so that we create headroom for us, right, from a growth perspective. We already spoke about some areas we discontinued FY23 in Q2, and we have a similar pipeline which we'll continue to act on and constantly update you. We have a lot of headroom on operating efficiency. You saw some of the metrics I spoke about on subcontracting, offshoring. A lot of automation opportunity in all of the deals. We already spoke about, CP mentioned, Kunal and the team is working on how do you get more automation each and every large deal that we bid, right? And that's where the team is getting integrated to get the benefit. So we'll continue to work on that. Some of the large deal transition will help us in terms of maturity as we get better. And then from a long-term perspective, CP mentioned, we keep on looking at our geography mix, we keep on looking at our vertical mix, we keep on looking at our competency mix. Example, digital engineering, right? Digital engineering, we're investing more and more because we get better yields in that competency, right? So as we grow more and more of that business, our margins will get better from a mix perspective. So again, we have a roadmap for the next 2 to 3 years on expansion. We keep on looking at it every week, every month, every quarter, and we will continue to execute on these metrics and update you on a regular basis. But this is something that, as CP also mentioned, is the most important area for us in terms of driving better operations. On M&A strategy, I'd like to invite Vivek. He'll give you a roundup in continuation of last year. We spoke to you about our investment. We'll talk about how these companies are doing overall as a portfolio, as well as maybe talk about top 2 or 3 investments and how they specifically are behaving. So Vivek, request you to take next few pages.
Thanks, Rohit. So as all of you know, and CP and Rohit have spoken about that last 1 year or about 1 year, we haven't done new acquisitions. So we've been focused on performance, integration. So next few pages, I'm going to walk you through what we're doing right now. This is a slide which is very similar to what we shared last year. Our acquisitions are based on certain themes where we've tried developing and scaling our capability across high growth areas. That also aligns with how we've integrated these businesses within the core of the company. And the integration has been at many levels. It's been around integration of client accounts, account teams, how we go to market, back office and systems and processes integration. And lastly, and most importantly, we've been focused on portfolio integration, which is on saying what does the combination of these businesses with our core create additional and incremental value for our customers. And as we walk through these slides, and these are some numbers very similar to what we shared at the last event. We've deployed about $1.2 billion of capital in our acquisitions over the last 5 years. This is cumulative numbers over the last 5 fiscal years. And just from a performance perspective, since the time we've acquired these businesses, and these are standalone numbers only, and I'll talk about synergies separately. These businesses have continued to grow at 4.3% CQGR, which is close to 20% annualized growth rate, which is reflective of the capabilities and the service offerings which came into our portfolio as part of these acquisitions. And we've expanded our margin since acquisition of 90 basis points. So largely, when we put our business cases together as a portfolio, both from a revenue growth perspective and margin, the 1.2 billion of investment which we've made is on track to deliver the returns which we anticipated on the acquisitions. A very quick update on the three biggest transactions we did in the last couple of years. This has been the most significant capital allocation from our perspective. It's about 50% of what we've invested in. And this is, I'm not going to read all of it because the slides will be available, but just I wanted to largely say on revenue growth, synergy, and our integration. We are on plan. There have been hiccups. I do want to call out especially the largest acquisition we did was CTCo. If you recall, the business had an operation in Belarus, and because of the war in the region, we had to shutter that operation very early after our acquisition. I think we've gotten behind that. The business is focused on not only growing organically, and I think we are on track to deliver its top line numbers. Short-term impact on profitability, which is behind us because of the war and the needing to shut down a set of operations. And we're driving global synergy. We're driving synergy in the insurance space. And more importantly, we're driving synergy from our global clients for digital engineering solutions delivered in that part of the market. Digital on Us and Elias, two other acquisitions in the digital space and the high-tech industry. One helped build and scale our cloud capability and our global delivery capability around cloud. And the second one is focused on hyperscalers and helps deliver engineering solutions for the high-tech industry. Again, on plan, except a little bit of slowdown in the high-tech industry is impacting the Elias synergy revenues, but on a standalone basis, we're doing well. I think the only other point I want to remind is all our acquisitions and our business cases are based on standalone, and I think anything we create on synergy is additional value creation in our evaluation. This is largely, the process we've been following, consistent, standardized playbook and approach on how we are going about integrating our acquisitions. Synergy, big focus area for us in terms of how we look at it. There is a lot of joint account planning across our existing clients which come through the acquired businesses, and a significant amount of focus in creating the right solutions with the combination of capabilities. What you will see in a number of sessions later today is real examples of how that synergy is working and where we have brought capabilities together. So I'm not going to talk about specific examples here, but a large part of our large deals, what the numbers you saw from Rohit and CP spoke about it, now have a significant combination of and contribution from the capabilities through our acquired businesses in all our proposals. Rohit?
Thank you, Vivek. So we'll keep this part which Vivek just spoke to you about as a regular feature of updating you at least during this event, because we want to make sure that from our capital committed perspective, you get a flavor of how this is going, right? This is very important. Just to wrap it up from our perspective, the fourth area, which is capital return, we're committed to it. We will continue to stick on to the policy we've communicated. I'll reiterate, any free cash flow that we generate minus the M&A goes back in terms of capital return to shareholders. That's what we've articulated. And over a period of last 3 to 4 years, the ratio has been, 64% has been returned back. The rest has been invested in M&A. So that's the indicative range we had given as well. When you look at comparison of last few years to last 2 financial year, you see our payout ratios up from 50 to almost 87%. Our interim dividend, CP mentioned about, was up from 15 rupees to 18 rupees per share. And we'll make sure that, our cash required for the business is optimized, and everything beyond that is as per this policy. So all in all, wrapping it up in terms of our recap of strategy, we'll focus on organic growth, drive margin expansion, drive value from our investments on inorganic side so that we get the right synergy, and then make sure that we stick on to our capital return policy that we've communicated to you. So thanks for the time, Vrinda. Thank you.
Thank you, Rohit. Thank you, Vivek, for those insightful number crunching.